Ladies and gentlemen, brace yourselves for a seismic shift in the sportswear industry. Nike, the global titan renowned for its iconic swoosh, has issued a stark warning. Brace for a double-digit percentage drop in sales this quarter. This alarming forecast stems from a trifecta of challenges: escalating tariffs, waning consumer confidence, and a sluggish turnaround strategy. In a candid conference call with analysts, Chief Financial Officer Matt Friend revealed that Nike anticipates a sales decline at the low end of the mid-teens range for the fiscal fourth quarter, concluding in May. This projection is grimmer than Wall Street's expectations, which had predicted an 11.4% drop. Additionally, the company foresees its gross margin plummeting between 4 and 5 percentage points as it aggressively liquidates excess inventory and outdated styles that no longer captivate consumers, a process expected to extend into fiscal 2026. Friend elaborated, "We believe that the fourth quarter will reflect the largest impact from our actions, and that the headwinds to revenue and gross margin will begin to moderate from there." He further highlighted the myriad external factors fueling uncertainty in the current operating environment, including geopolitical dynamics, new tariffs, volatile foreign exchange rates, and tax regulations. These elements collectively erode consumer confidence, casting a shadow over Nike's financial health. The repercussions of this announcement were immediate and severe. Shares tumbled over 4% in extended trading and have declined more than 5% year-to-date as of Thursday's close. Investopedia. Despite these daunting challenges, Nike managed to surpass Wall Street's expectations in its fiscal third quarter. The company reported earnings per share of 54 cents, eclipsing the estimated 29 cents, and revenue of $11.27 billion, surpassing the anticipated $11.01 billion. However, these figures still represent a significant downturn from the previous year, with net income plummeting to $794 million from $1.17 billion, and sales dropping approximately 9% from $12.4 billion. Investopedia. A closer examination reveals that Nike experienced robust demand in December, followed by double-digit declines in January and February. The gross margin shrank by 3.3 percentage points to 41.5%, primarily due to costs associated with clearing out old inventory in favor of new, innovative styles. The company attributed this decline to higher discounts, higher inventory obsolescence reserves, higher product costs, and changes in channel mix. Geographically, the picture is equally troubling. Sales in China, a critical market for Nike, plummeted 17% to $1.73 billion, falling short of expectations. North America, Nike's largest market, saw a 4% sales decline to $4.86 billion, although this was slightly better than analyst projections. CEO Elliott Hill, who returned to Nike last year, acknowledged the fierce competition and the uphill battle the company faces. He stated, "I spent some time over there in December. I hadn't been over there in a while. The competition is a bit more aggressive than what I remembered, so we just got to accelerate our pace." Hill, now 5 months into his tenure as CEO, is striving to rejuvenate the brand by rekindling innovation, mending relationships with wholesale partners, and enticing back athletes who have defected to competitors. However, these efforts have yet to yield significant results. Hill conceded, "While we met the expectations we set, we're not satisfied with our overall results. We can and will be better." Compounding these internal challenges are external pressures, such as new tariffs imposed by President Donald Trump, declining consumer sentiment, and weaker-than-expected retail sales in both January and February. Approximately 24% of Nike suppliers and manufacturers are located in China, making the company particularly vulnerable to these tariffs. The company has not disclosed whether it will raise prices or how the new duties will affect margins. As consumers tighten their belts, discretionary products like new clothes and shoes are often the first to be cut from budgets. This trend has led to a sluggish sneaker and apparel market, with even the strongest companies sounding alarms about soft consumer spending, raising concerns about the health of the economy. Moomoo. Nike's turnaround plan hinges on reigniting innovation and producing industry-leading shoes and apparel. Early releases of the new Pegasus Premium have nearly sold out across North America, and the Vomero 18, designed for everyday runners, has seen outstanding results. Additionally, Nike's collaboration with Kim Kardashian Schemes to create the Nike Schemes line aims to bolster its appeal to female consumers and compete more effectively with brands like Lululemon, Alo Yoga, and Vori. Despite these initiatives, the road to recovery appears long and fraught with obstacles. The combination of internal restructuring, external economic pressures, and fierce competition paints a challenging picture for Nike's future.